85 million ounces of silver just vanished from the open market. Not because of a government, not because of a central bank, because one man signed off on it. Today is Wednesday, January 15th, 2026. And 48 hours ago, on Monday, January 13th at 11 a.m. Eastern, Elon Musk personally approved the largest silver acquisition in Tesla's history. 85 million ounces. That's not a typo. That's not rounded. That is 85,000 ounces of physical silver, locked up through spot purchases, forward contracts with miners, and direct transfers out of vaults. And here's where it stops being just another big order. Samsung Electronics, the company widely expected to leapfrog the EV space with its solid-state battery technology, the company whose flagship design requires roughly 1 full kilogram of silver per car, tried to buy a big chunk of that same metal. They negotiated, they raised their bids, they offered aggressive premiums, and they still lost. Tesla outbid them. Tesla got the metal. Samsung is now staring at a production crisis that could delay its entire solid-state battery rollout by 12 to 18 months. This is no longer about price. This is about who can get physical metal at all. And while you watched silver tick to a new all-time nominal high yesterday, $92.25 per ounce, while financial commentators debated whether silver was overbought, a quiet war was raging in the background. A war for actual bars, not paper contracts, not ETF shares, real deliverable silver, two giants, one bottleneck, and a terrifying realization they both share. The amount of silver needed to power the next wave of electric vehicles, grid-scale batteries, and green energy systems does not exist in freely available form. Vaults are being drained, mines cannot ramp quickly enough, and the players who lock in supply now will control the next decade. Those who don't, they get left behind. Stay with me because I'm going to walk you, step by step, through how this procurement war unfolded, why it redraws the entire EV and energy storage landscape, and why $120 silver is an OT a wild prediction. It now was the next logical stop on a math-driven path. On January 13th, 2026, at 9:30 a.m. Seoul time, Samsung AS Global Supply Chain Director opened an emergency video conference with the company AS Executive Committee. The internal title sounded harmless: Critical Material Acquisition Status Update. The reality was panic. For the last 18 months, Samsung has poured money and talent into what they consider their biggest battery breakthrough since commercial lithium-ion, a solid-state battery that uses a silver-carbon composite layer in the anode to stop dendrites. If you're not familiar, dendrites are tiny metallic spikes that can form inside batteries during charging. If they grow far enough, they pierce the electrolyte, causing failures or even fires. By embedding silver into the anode structure, Samsung's engineers found a way to suppress that growth. The results on paper are stunning. About 600 miles of range, around 9-minute full charge times, and well over 1,500 cycles with minimal degradation. This isn't a small efficiency tweak. It's a true generational leap. But there's a brutal trade-off wired into that chemistry. Each cell in Samsung's design uses roughly 5 grams of silver. A typical 100 kilowatt-hour EV pack needs about 200 of those cells. Do the math. 5 grams per cell, 200 cells per pack. That's 1,000 grams, 1 full kilogram, of silver per vehicle. About 32 troy ounces in every single car. A conventional EV today might use 25 to 50 grams of silver total, mostly in electronics, contacts, and circuit boards. Samsung's solid-state design multiplies that by about 40, and this isn't for a boutique luxury car. Samsung plans to go mass market. Their internal projections target around 2 million solid-state EVs per year by 2028. 2 million vehicles, 32 ounces each. That is 64 million ounces of silver per year just for those cars. Add their energy storage systems, consumer electronics, and appliances, and you end up with Samsung AS total annual silver requirement easily exceeding 85 million ounces once they fully ramped. Samsung understood this. They had models. They had forecasts. What they misjudged was one crucial assumption. They believed the silver would be there when they went to buy it. In December 2025, Samsung's procurement team made their move. First, they went to COMEX, the largest silver futures exchange on the planet. They requested delivery of 20 million ounces for the first quarter of 2026 to start building inventory for pilot production. COMEX could offer 3.2 million ounces. That's 16% of what they asked for. Next, they turned to major bullion dealers, SD Bullion, APMEX, JM Bullion, Kitco, and more than a dozen others. Across the board, the dealers could collectively commit to roughly 4.8 million ounces, with delivery times stretching from 12 to 18 weeks, no guaranteed pricing, and premiums between $18 and $32 over spot. Still nowhere close. So Samsung went upstream to the miners. They contacted Pan American Silver, First Majestic, Hecla, Kerr, and virtually every major producer in Mexico, Peru, and Canada. The response was blunt. Around 92% of 2026 mine output was already spoken for under multi-year contracts, signed in 2022, 2023, and 2024. The uncontracted production, the global loose tonnage they could fight over, was about 11 million ounces. Samsung needed 20 million ounces for Q1 alone. From every avenue combined, they could lock in around 8 million ounces. A 12 million ounce shortfall in the very first quarter. And that deficit wouldn't be a one-time problem. It would compound every 3 months. By the end of 2026, if nothing changed, Samsung was staring at a projected shortage of roughly 55 to 60 million ounces. No silver, no solid-state batteries, no way to fulfill the supply contracts they'd already signed with automakers. So they did what big corporations do when they're cornered. They raised their bids, premiums of $35 over spot, then $40, then $48 over COMEX. And that's exactly when Tesla stepped onto the battlefield. On January 13th, 2026, at 11:00 a.m. Eastern, Elon Musk reviewed Tesla's raw material projections and made a decision. He authorized Tesla's procurement team to secure 85 million ounces of physical silver by any means necessary. Price was secondary. Availability was everything. To see why that number is so large, you have to stop thinking of Tesla as just a car company. That label has been outdated for years. Tesla is really 3 intertwined businesses: automotive manufacturing, energy storage and generation, and advanced battery cell production. Start with vehicles. Tesla delivered roughly 1.8 million cars in 2024. Their target for 2026 is around 2.2 million. Each current Tesla, using 2,170 and 4,680 cells, contains in the ballpark of 30 to 50 grams of silver, once you include the battery, inverters, onboard chargers, power electronics, and control systems. That works out to about 8 to 9 million ounces of silver per year, just for the automotive division. Now look at energy storage. This is the part the market still underestimates. Tesla, S-Megapack, and Powerwall deployments jumped more than 60% in 2024 compared to 2023. The energy business is now growing revenue faster than the vehicle side. A single Megapack contains around 200,000 individual cells. Once you account for silver in bus bars, interconnects, thermal systems, and power conversion electronics, you end up with roughly 12,000 grams of silver in each Megapack. That's about 385 troy ounces per unit. Tesla's 2026 production target for Megapacks is 8,000 units. 8,000 Megapacks at 385 ounces each is about 3.08 million ounces of silver. Add Powerwalls to the picture. Let's say 25,000 units at roughly 60 ounces each. That's another 1.5 million ounces. So the energy storage and generation segment alone consumes in the neighborhood of 4.58 million ounces of silver annually. Now comes the part most people miss. In 2026, Tesla plans to roll out 4 new battery cell designs, internally dubbed NCA5, NC20, NC30, and NC50. NC stands for New Cell. NCA5 is geared toward Tesla's lower-cost $25,000 model, Robotaxis, and the Cybercab. NC20 is meant to power the SUV lineup and the Cybertruck. NC30 and NC50 are more advanced chemistries that lean heavily on silicon anodes. Silicon expands and contracts dramatically during charging cycles, which causes mechanical and thermal stress. Industry analysts who've studied Tesla's patents estimate that to manage those stresses, these new cells will use about 15 to 25% more silver than today's 46 and 80 cells. If Tesla actually ramps these new designs enough to hit Elon Musk's stated target of more than 3 million vehicles per year by 2027, silver demand from their battery manufacturing surges. Add up the automotive needs, the energy storage growth, and the extra silver baked into next-gen cells, and Tesla's total 2026 silver requirement lands somewhere around 18 to 22 million ounces. So why secure 85 million? Because Elon Musk decided to learn the lesson before it became a crisis. When a material is mission critical to your entire business, you don't buy just in time. You buy ahead of time. You build a buffer. You corner as much reliable supply as you can before your competitors realize there's a shortage. And that's exactly what Tesla did. They didn't get 85 million ounces from a single source. They stitched it together from 4 different channels. First, direct mine contracts. Tesla signed forward delivery agreements with 6 primary silver miners. These deals are structured as prepayments. Tesla fronts capital today in exchange for guaranteed tonnage over the next 24 months at fixed prices. That route alone secured roughly 32 million ounces. Second, vault acquisitions. Tesla quietly negotiated with 2 large institutional holders with silver stored in LBMA-approved vaults in London and Zurich. Those institutions, under pressure from margin calls and in need of liquidity, agreed to sell parts of their physical holdings at a premium. The bars were moved from their allocated accounts into Tesla's newly established vault accounts. Total, about 18 million ounces. Third, exchange-related channels. Tesla did not simply stand for delivery on giant futures positions. That would have publicly squeezed COMEX and sent prices skyrocketing overnight. Instead, they worked through intermediaries to accumulate expired warrants and purchase metal from smaller market participants, liquidating positions. That path netted around 12 million ounces. Fourth, off-market industrial deals. Tesla approached three major Asian electronics manufacturers that had built up silver stockpiles during the 2022-2023 window, when prices were lower and supply looked abundant. Those firms, now under profit pressure and facing softer demand in some product lines, agreed to sell portions of their strategic reserves. The deals were structured as swaps and deferred delivery arrangements to minimize immediate tax and accounting impacts. That added roughly 23 million ounces. Added up, 32 plus 18 plus 12 plus 23 equals 85 million ounces. According to multiple sources familiar with these contracts, this is not speculation. Agreements exist. Metal has moved. And Samsung, they were trying to buy overlapping pieces of the very same pool of silver, negotiating with the same miners, the same vault holders, even some of the same industrial hoarders. In case after case, they were outgunned. Tesla's bids weren't just slightly higher, they were dramatically higher. With COMEX spot around $90 per ounce during the scramble, Tesla was reportedly offering premiums of $50 to $70 per ounce for large, guaranteed deliveries. That means Tesla paid the equivalent of $140 to $160 per ounce for some of this physical silver. Samsung's executives had only authorized premiums up to $48 over spot. Anything beyond that required fresh board-level approval, a slow process inside a diversified giant that's also funding semiconductor fabs, display plants, and consumer electronics lines. Tesla moved faster. Tesla paid more. Tesla took the metal. What Tesla just did is not simply an opportunistic bulk order. It's a signal. One of the most sophisticated manufacturing companies on Earth has effectively said, "We no longer trust the normal market to deliver the silver we need in the size we need at any predictable price." Now imagine what happens when others draw the same conclusion. Apple, Google, BYD, LG, Panasonic. Automakers, solar manufacturers, data center builders. Once they realize they're all competing for a finite pool of deliverable metal that's already too small, bidding doesn't just increase slowly, it can go straight up. Let's run the numbers so you can see why. Global silver mine production in 2025 was about 780 million ounces. Roughly 70% of that, around 546 million ounces, comes as a byproduct of mining copper, zinc, lead, and gold. In those operations, silver is not the main revenue driver. So even if silver's price doubles, those mines don't dramatically ramp silver output. Their decisions are tied to base metal economics. Only about 30% of supply, around 234 million ounces, comes from primary silver mines. That means silver's supply is structurally inelastic. It doesn't respond quickly to higher prices the way you might expect from other commodities. Now look at demand. Industrial demand for silver in 2024 hit a record somewhere in the region of 685 million ounces, based on aggregated industry data. Solar panels consumed around 200 million ounces. Electric vehicles and charging infrastructure used about 55 million ounces. Electronics and semiconductors took roughly 90 million. 5G networks, data centers, and AI-related hardware accounted for around 45 million ounces. Add in investment demand, jewelry, and silverware, and total demand for 2024 came in near 1.05 billion ounces. Supply, 780 million. Demand, 150 million. That's a deficit of about 270 million ounces. Where did that extra 270 million come from? From above-ground inventories, from exchange and ETF stockpiles, from private vaults, from recycling flows, from investors surrendering bars and coins. But those sources are not infinite. Data from the London Bullion Market Association and COMEX show that registered silver inventories in Western vaults have fallen by more than 70% since 2020. On COMEX, registered silver, the metal actually available for immediate delivery against futures, collapsed from about 346 million ounces in 2020 to roughly 82 million ounces by late 2023. Total COMEX warehouse silver, as of January 7th, 2026, is around 445 million ounces, but only a fraction of that is truly registered and easily deliverable. The trend is obvious. Vaults are being drained. They are not being meaningfully refilled. Now overlay Tesla's move. They have just removed 85 million ounces from that dwindling pool. That's more than the entire registered inventory on COMEX. If one company can quietly absorb more silver than COMEX has officially registered for delivery, ask yourself, what happens when 5 companies try to do something similar? What happens when Samsung, after losing this round, decides it needs to lock down 100 million ounces to avoid ever being in this position again? What happens when Apple, watching Tesla and Samsung scramble, decides to pre-buy years' worth of silver for its devices and any future battery projects? This is how you get a doom loop. Scarcity leads to hoarding. Hoarding deepens scarcity. Prices rise. The price move attracts more hoarding. And at some point, the pile of paper promises, futures, ETFs, unallocated accounts, runs straight into the hard wall of finite physical metal. Now, bring it back to Samsung's solid-state dream. This isn't just a lost procurement battle. This is an existential threat to what was supposed to be their defining technology for the next decade. In March 2024, Samsung unveiled their solid-state breakthrough. The media reaction was euphoric. A battery that charges in minutes, offers a 600-mile range, and lasts up to 20 years. This was hyped as their iPhone moment, the product that could catapult them past Tesla, past BYD, past everyone. They signed memorandums of understanding with Stellantis, Hyundai, and a major German luxury brand, agreeing to start supplying solid-state packs starting in 2027. Those contracts are thought to be worth around $18 billion in revenue over 5 years. But those contracts have teeth. They include guaranteed delivery timelines. If Samsung can't deliver packs on schedule, the automakers can cancel and go elsewhere. And right now, Samsung can't deliver because they don't have enough silver. They tried to get 20 million ounces for the first quarter of 2026. They ended up with around 8 million. With 8 million ounces, they can probably build something like 250,000 packs, enough for pilot lines, testing programs, and limited early runs, but nowhere near enough for mass production. So on January 14th, 2026, Samsung's executive committee held another emergency meeting. It lasted around 4 hours. People who were there described the tone as grave. Their chief supply chain officer laid out 3 options. First, delay the solid-state launch by 12 to 18 months, hoping the silver situation stabilizes. That preserves the technology roadmap, but risks losing some or all of those automaker contracts. Second, redesign the battery to use less silver. You keep the original timeline, but you pay in performance. Early estimates suggest cutting silver content by 50% would reduce range from around 600 miles to about 420, and extend fast charge times from roughly 9 minutes to around 16. That would erase much of their advantage. Third, acquire a silver mining company. Make a full vertical integration play. Spend $3 to $5 billion to buy a primary silver miner, then spend 2 to 3 years boosting production. Very expensive, not fast, but it would lock in supply for the long term. The fact that a consumer electronics giant is even seriously considering buying a mining operation tells you how desperate this has become. Meanwhile, Tesla sits on 85 million ounces. They have enough silver to comfortably power their 2026 and 2027 production plans with a safety margin. They have largely removed the same silver supply risk that is now freezing Samsung's strategy. If you're an automaker deciding whether to bet on Samsung's cutting-edge solid-state packs, knowing they might not have the raw material, or to stick with Tesla's proven 4680 cells backed by a company that already secured its key metals, which partner looks safer? This isn't just about tech anymore, it's about logistics and raw materials. And here's what most people still don't see. This silver crunch is not just a 2026 problem, it's a structural 2026 to 2035 issue. Bringing a new silver mine from discovery to production typically takes 8 to 12 years. You have exploration, feasibility studies, permitting, community negotiations, financing, construction, and commissioning. Even if someone finds a giant deposit today and fast-tracks everything, meaningful output doesn't show up until around 2034. And the easy deposits are mostly gone. High-grade, shallow ore bodies have been mined out. Modern silver mines are dealing with lower grades, deeper ore, and higher costs. Average silver ore grade has fallen from around 15 ounces per ton in 2005 to roughly 4 ounces per ton by 2025, a drop of about 73% in 20 years. To get the same ounces, miners now have to process nearly 4 times as much rock. That means more fuel, more electricity, more water, more equipment, more labor, and more environmental costs. At around $90 per ounce, many primary silver mines are just about breaking even. If energy and operating costs rise or grades fall further, those mines may cut production or shut down rather than expand. Analysts estimate that silver needs to trade consistently above roughly $150 per ounce to justify heavy investment in new primary projects. And even then, the lead time means new supply won't materially hit the market until the 2030s. So for at least the next 5 to 7 years, global mine supply is effectively capped at around 780 million ounces per year, plus a relatively fixed contribution from recycling. There is no strategic reserve waiting in the wings. Governments sold most of their silver hoards decades ago. The United States, for example, once held billions of ounces and sold off the last of its stockpile in the early 2000s. Meanwhile, demand keeps accelerating. The solar industry alone is projected to consume more than 230 million ounces in 2026. Global EV production is expected to rise from around 14 million units in 2024 to about 17 million in 2026. At current 30 to 50 gram usage per EV, that's significant. If solid-state designs that use 1 kilogram per vehicle catch on, the numbers go parabolic. Look at data centers, driven by AI and cloud computing. Total data center power capacity has exploded from under 1 gigawatt around the year 2000 to nearly 50 gigawatts by 2025, more than a 50-fold increase. Every server, every networking switch, every power distribution unit uses silver. Solar, EVs, batteries, data centers, telecom, all of that demand is non-discretionary. You cannot build those systems without silver, and the companies that control the silver will control the pace of the energy transition. If this is all starting to click, if you're beginning to see how fragile this supply chain really is, take a moment to share your thoughts in the comments, and subscribe so you don't miss what happens next. Because the next part of this story is where things really accelerate. Let's talk about price. Yesterday, January 14th, 2026, silver closed at $92.25 per ounce, an all-time nominal high. That sounds high, but in the context of this supply and demand picture, it's still cheap. Consider a conservative scenario. Samsung decides that to protect its solid-state program, it must secure at least 100 million ounces over the next 2 years. At the same time, Tesla's 85 million ounce move becomes widely known, and other giants, Apple, Google, BYD, LG, realize they might also be at risk. Suppose that together these companies attempt to lock in 300 million ounces over the next 12 months. Where does that metal come from? Not from mines. They're already working flat out, and most output is pre-sold. Not from some new discovery. Those are years away. Not from recycling alone. Recycling contributes around 180 million ounces a year, most of which is already spoken for. That 300 million ounces has to come from existing holders. Investors who bought physical silver at $20 or $30 and are thinking about taking profit. ETFs and funds that might sell bars to meet redemptions. Industrial users willing to part with surplus inventory at the right price. What price convinces them? If you're sitting on physical silver and you see that Tesla willingly paid the equivalent of $140 to $160 per ounce for big off-market deals, why would you sell at 90? You wouldn't. You'd wait. You'd demand 120. You'd ask for 150. You might hold out for 200 and beyond, especially once the shortage becomes common knowledge. The crucial thing to understand is that the big industrial buyers aren't particularly sensitive to the price of silver itself. They're sensitive to whether they can get it at all. Take a typical EV. At 30 to 50 grams of silver per car and a silver price of $90 an ounce, you're talking about $90 to $150 worth of silver in a vehicle that might sell for $50,000. Even if silver triples to $270 an ounce, you're looking at roughly $300 of silver content, well under 1% of the sticker price. When the alternative is shutting down your factory, you pay it. When supply is inelastic, demand is non-negotiable, and the cost impact on the finished product is small, prices don't just grind higher. They can go vertical. We've seen a version of this before in palladium. In 2017, palladium traded around $700 an ounce. By 2021, it had spiked to about $3,000. Automakers needed it for catalytic converters, and substitution was hard. Supply couldn't keep up. Silver is palladium on steroids. It's used in more sectors, touches more supply chains, and has a second identity as a monetary metal. Once investors realize that industrial users are panic buying, once they see Tesla hoarding tens of millions of ounces, once they understand that vault inventories are razor thin, investment demand can act like gasoline on a fire. Retail investors pile in, institutions allocate. Even sovereign wealth funds might decide they want a slice of physical silver that can add another 200 to 300 million ounces of demand a year on top of industrial needs. At some point, COMEX and major ETFs will be under intense pressure. If they can't easily meet physical delivery and redemption demands, the gap between paper silver and actual bars in your hand starts to widen. Trust in the paper side erodes. To see how this could unfold, let's sketch a plausible 6-month roadmap for 2026. In February, the March silver futures on COMEX hit first notice day on the 12th. As of mid-January, there are about 45,000 open contracts in that month. Each contract represents 5,000 ounces, so that's 225 million ounces of potential delivery obligations. COMEX registered inventory sits around 82 million ounces. If just 20% of those contract holders decide to stand for delivery, that's 9,000 contracts, or 45 million ounces, more than half of the registered pool. To avoid a visible squeeze, the exchange is likely to raise margin requirements, tighten position limits, and offer cash bonuses to encourage cash settlement instead of physical delivery. That might buy time, but it won't restore confidence. As more traders question whether COMEX can really deliver in size, price jumps. By the end of February, it's reasonable to imagine silver trading somewhere in the $105 to $112 range. In March, Samsung officially announces a delay in its solid-state battery rollout. The press release will use polite phrases like supply chain optimization or extended testing, but the market will understand they don't have the silver. Automaker partners start renegotiating. Some quietly shift plans. Samsung's stock takes a hit. Other manufacturers take a hard look at their own supply chains and start realizing that if Samsung, with its scale, can't get the metal, smaller players are even more exposed. The scramble intensifies, and by the end of March, silver could plausibly be trading in the $118 to $128 range. In April, Tesla reports record first quarter earnings driven heavily by its energy storage business. On the earnings call, someone asks about raw material costs. Elon might not explicitly reveal the 85 million ounce number, but he might say something like, "We've secured our key materials for roughly the next 2 years. We're not materially supply constrained." Analysts connect the dots. If Tesla needs around 18 to 22 million ounces a year, and they've secured 85 million ounces, that's more than 4 years of coverage at current run rates. That gives Tesla an enormous operational advantage over competitors scrambling for material. Silver stops being just another commodity in the eyes of mainstream investors and starts looking like a strategic asset. By the end of April, silver could be trading in the $135 to $148 range. In May, one of the large silver ETFs, maybe SLV or PSLV, announces a temporary suspension of share for metal redemptions, citing unusually tight market conditions. The ETF still trades, but investors can't easily swap shares for bars. The arbitrage mechanism that usually keeps ETF prices aligned with physical breaks down. Physical silver starts trading at a huge premium over the ETF price. Dealers begin charging $50, $70, even $100 per ounce over the ETF price for coins and bars. Delivery wait times stretch to 16, 20, even 30 weeks. People finally realize the simple, cheap path from paper silver to physical silver just closed. Panic buying of physical metal accelerates. By the end of May, silver could be somewhere between $158 and $172 per ounce. In June, China announces an expansion of export controls on critical minerals, and this time, silver is explicitly designated as strategic. Export quotas are cut again, perhaps by another 20%. Chinese companies, BYD, CATL, domestic solar, and electronics manufacturers, get priority access to silver. Western buyers get whatever is left, which is increasingly negligible. Prices in Shanghai and on COMEX diverge. Shanghai might trade at $200 an ounce, while COMEX shows $160. But the gap can't be arbitraged away because there's no spare metal to move in size. Western manufacturers are effectively locked out of a major slice of global supply. By the end of June, silver could be trading in the $175 to $195 range. Beyond that, mid-sized manufacturers who failed to stockpile early are forced into a brutal choice. Pay whatever the market demands to keep production lines running, or shut down and watch competitors take their customers. When even $300 silver still represents less than 1% of the total value of a high-end EV, you can guess which option many will choose. Now, let's zoom out. Tesla's 85 million ounce silver purchase is not just clever logistics. It's a strategic survival move. They're not trying to rig the silver market. They're trying to insulate themselves from a supply chain that's showing visible stress fractures. But by acting early and in such size, they've accelerated the reckoning for everyone else. Because now, every major CEO, CFO, and head of supply chain in tech and autos is quietly asking, do we need to do what Tesla just did? For many of them, the answer is yes, but the window to act without moving the entire market is closing fast. So what does this mean for individuals? If you already hold physical silver, the same metal that some of the world's largest companies are scrambling to buy at huge premiums, you're sitting on an asset the market is quietly reclassifying as strategic. Tesla has already shown it's willing to pay the equivalent of $140 to $160 per ounce for large blocks. That raises a hard question. Why would long-term holders rush to sell at 90? Most won't. They'll wait. They'll look toward 120, 150, 200 and beyond, especially if the squeeze intensifies and the headlines finally catch up. If you're holding cash, waiting for the perfect dip, you need to understand how pullbacks work in a true supply squeeze. You might not see 90 back down to 60. Instead, you might see 110 fall back to 95 before the next leg higher to 140. The floor keeps rising. None of this is guaranteed. No one can promise you a specific price target or timeline. And this is not financial advice. It's a breakdown of structural supply and demand, and of the strategic choices big corporations are making. But the facts are hard to ignore. Tesla has reportedly secured 85 million ounces of silver. Samsung struggled to secure even 20 million ounces for 1 quarter. Above-ground vault inventories in the West have dropped by around 70% since 2020. The 2024 silver market ran a deficit of roughly 270 million ounces. Solid-state batteries can require up to a kilogram of silver per vehicle. Solar, EVs, and data centers are all expanding. Mine supply is essentially fixed for years. And silver just printed a new record high, around $92.25. The market is sending a message. Industrial users are sending the same message through their actions. The question isn't whether silver might go up a little. The question is whether enough people recognize what is happening before the next phase of this squeeze plays out. We are in the early stages of what will likely be remembered as the silver battery war. And the cost of victory in this war is not measured in dollars saved today. It's measured in ounces, secured before everyone else realizes they're short. Tesla moved first and decisively. Samsung moved later and lost the first round. More players are about to enter the battlefield. Paper promises can stretch for a while. But factories run on atoms, not IOUs. Silver is the atom at the center of this story. When the headlines finally scream what the insiders already know, will you still be operating on the old narrative, or will you have positioned yourself for the new reality? If you found this breakdown useful, make sure you're subscribed, because this story is only just beginning, and the next chapters may reshape not just the silver market, but the entire future of energy and technology.